Kotak Mahindra Bank, growth lags, margin worries, and the road to recovery. Shares of Kotak Mahindra Bank dropped sharply by 4.6% on Monday, May 5th, marking their steepest single-day decline in nearly a year. The market reaction came on the back of weaker than expected fourth quarter numbers and subsequent downgrades from multiple brokerages. Despite signs of operational stability, the earnings report revealed underlying stress points, including higher provisions and soft loan growth that left investors wary. So what exactly do the bank's numbers tell us? Let's break it down. Welcome to Bottom Line by Grow. In today's episode, we'll discuss Kotak Mahindra Bank's earnings report and what is driving the cautious sentiment in the market. Let's start first with what rattled the stock: a sudden spike in provisions. Kotak Mahindra Bank saw its provisions more than triple to 909 crore rupees in the March quarter of FY25, setting off alarm bells across the street. In simple terms, Kotak Bank just handed a reality check to investors, and not a pleasant one. The bank's Q4 FY25 net profit fell 14% year-on-year to 3,552 crore rupees, missing analyst expectations by a wide margin. The elevated levels provisions, primarily linked to stress in its microfinance loan portfolio, overshadowed the otherwise steady operational performance. For a bank long regarded for its steady hands and pristine books, a sharp rise in provisions naturally raises eyebrows. While the management hasn't pointed out to any major asset quality blow-ups, a spike in provisioning often signals a more cautious stance on future repayments. That said, Kotak Bank's core fundamentals remain intact. Loan and deposit growth were healthy, asset quality saw an improvement, and capital buffers are strong. But here's the catch. When a stock trades at premium valuations of 2.6 times price to book, compared to peers like Axis Bank at 1.9 times price to book and Federal Bank 1.3 times price to book, even minor earnings disappointments can hurt. And that's exactly what we are seeing play out. Next, let's take a look at the asset quality. While asset quality remained broadly stable on the surface, gross and net NPAs declined marginally to 1.42% and 0.31% respectively. The increase in provisioning could suggest stress is still brewing beneath the surface. Gross slippages came in at 1,488 crores for the quarter, slightly higher than the previous quarter. However, elevated credit costs, driven by rising provisioning coverage and aging of unsecured loans, dragged on the bottom line. As such, write-offs jumped in Q4 FY25, indicating that more loans were deemed unrecoverable. Kotak Bank also made provisions of 56 crore rupees on its AIF investments, adding to the cost pressures. Management guided for credit costs to stay elevated in the first half of FY26, particularly due to lingering stress in the MFI segment. That said, one of the few positives was the sequential improvement in net interest margins, which rose by 4 basis points to 4.97% in Q4. The lifting of the RBI embargo in February 2025 came as a welcome relief for Kotak Mahindra Bank, offering a much-needed boost to both margins and growth levers. On the asset side, the move enables the bank to resume high-yielding unsecured lending, particularly credit cards, which has been on hold. On the liability side, it allows the revival of 811, Kotak Bank's digital onboarding platform, helping the bank rebuild its base of granular, low-cost deposits. To recap, the embargo was initially imposed by the RBI on April 24, 2024, when Kotak Bank was barred from onboarding new customers via digital channels and issuing new credit cards, though it could continue servicing existing clients. The regulator cited deficiencies in Kotak Bank's IT systems and controls, which were seen as inadequate given the bank's scale and growth. Now, concerns remain on margin sustainability. With a large chunk of Kotak Bank's loan book linked to external benchmarks, the falling interest rate environment could weigh on margins in the coming quarters. While Kotak Bank recently implemented a rate cut on its savings account, the margin trend needs to be monitored. Also, though the unsecured credit card space would aid margins, the management expects margins to be under pressure. Still, deposit traction was reasonably healthy. Deposits grew 5.2% quarter-on-quarter and 15% year-on-year. The bank also saw improved mix in traction in retail deposits. But concerns remain around Kotak Bank's relatively sluggish CASA growth, up just 2% YOY. In fact, savings account deposits have remained largely flat for the past 3 years. On the other hand, loan growth also came in below estimates. The bank posted a loan growth of 3% QOQ and 14% YOY. Adjusted for interbank participation certificates, average advances grew 18% YOY for FY25, but analysts were hoping for a stronger traction, especially given the bank's recent acquisition of Standard Chartered's portfolio. Retail lending was particularly soft. Key reason was RBI's embargo. Although the embargo has now been lifted, the drag in the retail loan growth was visible in the Q4 numbers. Management highlighted that slippages in personal loans have moderated and the credit card portfolio has plateaued for now, but microfinance remains a pain point that may take a few quarters to normalize. In terms of outlook, the Kotak Bank management expects loan growth to be 1 to 1.5 times of GDP growth. Additionally, cost pressure is likely to weigh on operational metrics going forward. The net interest income came in below expectations on account of higher operating expenses, which surged 8% QOQ, led by branch expansion, branding campaigns, and higher pension provisioning. The higher OPEX compressed the cost-to-income ratio and impacted profitability, even as other operational metrics like deposit growth and asset quality showed resilience. As the bank looks to regain momentum post-embargo, its investments in technology and distribution could keep OPEX elevated in the near term. What's the big takeaway then? To summarize, the market wasn't pleased with the earnings disappointment. The stock's sharp fall on May 5th reflected investor anxiety over future profitability, especially as provisioning trends and muted retail growth cast a shadow over near-term performance. The brokerage reaction was mixed. BofA Securities, Nomura, CLSA, JM Financial and Elara Capital downgraded the stock post-results, citing downside risks to earnings due to sustained provisioning pressure and tepid credit growth. However, global giants like Goldman Sachs, Citi, Macquarie and Jefferies maintained their bullish stance, arguing that the worst of the earnings hit is largely behind Kotak Bank and that a recovery is in sight now that the RBI embargo is lifted. So basically, FY25 was a tough year for Kotak Mahindra Bank. And while there are some early signs of stability, the road ahead looks uncertain. There were a few positives in the earnings report: sequential improvement in margins, a stable asset quality profile, and an improving deposit mix. These show that operationally the bank isn't in distress. However, the elevated credit card costs and increased provisions signal that the management is still very much in buffer building mode, reflecting caution more than confidence. Going ahead, FY26 performance hinges on a few critical factors: how quickly Kotak Bank can rebuild its retail engine post the RBI embargo, how it manages continued stress in the microfinance portfolio, and whether it can sustain margins in a softening interest rate environment. So, Kotak Bank's quarter wasn't a disaster, but it wasn't reassuring either. Investors have higher expectations from the bank, and this time it didn't quite deliver. If the management can steer through the margin and provisioning issues, Kotak Bank could bounce back strongly. But the street will want to see that before giving it full marks again. So what are your thoughts on Kotak Bank? Leave them in the comments section below. And for more insights, subscribe to Bottom Line by Grow.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.